Thank you for joining me on this podcast, and please accept my apologies that I only have an audio version of Ghost Bites available today. It's not even a complete version. Unfortunately, I haven't been able to catch up on the missed day because it became apparent late yesterday, by the time you're listening to this, that all still was not well with the website. This led to a change of plan to do only audio for you today. Let me just start with that issue. If you accessed Ghostmail on Wednesday night and you saw some kind of capture box, the one that says, "I'm not a robot," if you did that and you accessed the website during a very short window of time in which it had become compromised, i.e. when that thing was showing, then I need you to listen very carefully because the website has suffered a malware attack. The internet is a very scary place, even for ghosts. But really, this is no joking matter. If your antivirus somehow missed this issue, I know mine was bright red when I tried to access the site, and I'm hoping yours was too. Even worse, if you went ahead with your missed antivirus and then followed the instructions in that capture box and you actually allowed the thing to run something on your computer, then please get your PC checked out for malware. I cannot stress this enough. I also want to be very clear, Ghostmail does not hold your personal information. That is sitting on the email servers that send you your morning email. That is completely separate from the website. We send you to the website from the mail server. These two things are not actually related. So if you didn't follow the instructions on that fake capture box in that very short space of time when the website was compromised, then my understanding is you have nothing to worry about. But if you did, get your computer checked. We took the site down as quickly as possible when we found the issue, and we only went back up when my technology partners assured me it was clean. We then found a subsequent weird thing going on in the background around database updates of my content, and we took the site down again out of caution. If you have any questions, please email them to me on help.me@thefinanceghost.com so I can send them on to the technology team and we can address any concerns you may have. I'm going to say it one more time. Ghostmail is never going to ask you to make changes to your computer or to share personal information or to do anything that feels weird, ever. If you see something like that online, please do not trust it, especially in what is quite clearly an age of even higher cybersecurity risk, thanks to AI and everything else going on out there. Okay, let's move on to happier things, starting with Cashbuild, although I'm not 100% sure that it counts as a happy thing, but we'll dig into that now. So they've released a voluntary fourth quarter update, and for the quarter, revenue was up 6%, although their existing stores, which they define as stores that were there before July 2024, only managed to grow by 1%. That is not a lot. The new stores were therefore 5% of growth. Now, this quarterly growth is also consistent with how the full financial year went. That also grew by 6%. Another lens that you can use at Cashbuild is comparable store revenue, which excludes the impact of mergers and acquisitions and store closures. This metric grew by 3% in the fourth quarter and for the financial year as well, so quite interesting momentum here. They pretty much ended off the year exactly as the full year went as well. So overall, a somewhat pedestrian performance in the existing stores. Inflation was light. It came in at only 1.5% at the end of June 2026 versus June 2025. And when inflation is low like that, it doesn't really support sales growth. It leaves you reliant on volumes. And volumes are only going to come through if South African consumers are feeling better about where they live and investing in their properties. And unfortunately, existing stores suffered a decline in volumes. So that really is concerning during a period of, in my opinion, quite modest inflation and supposedly improved sentiment in South Africa. After all, load shedding is gone and we are getting sovereign rating upgrades in terms of our debt and all sorts of other supposedly lovely things. Yet, look at these numbers. Cashbuild really has been an unfortunate story where I absolutely should have taken profit at the end of 2024 in that period of GNU exuberance. Instead, I thought I would stick to my knitting and then hold it as a play on SA Inc. and things getting better and buy and hold. Well, the joke here is on me. Share price is now at 117 Rand versus the late 2024 peak of over 227 Rand. Very depressing. It did admittedly just blip at 227 Rand, but still you get the idea. So that is not a great situation. And unfortunately, I'm not really seeing anything now that makes me want to buy more. So I'm now stuck in that classic scenario where I'm not sure whether to give up or to add. It's just not where you want to be. So lesson here. Don't be so stubborn to buy and hold. If the market does something crazy and gives you a big rally, then you should probably take it. Moving on to another consumer story, and that is Mr. Price. Now, this is really at the other end of the consumer spectrum. If you think about it, Cashbuild requires you to want to spend money on property, whereas Mr. Price requires you to just want to wear some clothes. Doesn't seem too difficult, yet it is a competitive bloodbath. And because clothing is semi-durable, as is homeware, as is telecom type services as well in the form of cell phones, you end up in a scenario where if consumers are struggling, they can still defer their purchases at Mr. Price, just not as much as they can defer whatever it is they want to buy from Cashbuild. Now, Mr. Price has given the market a voluntary update for the 13 weeks to the 27th of June 2026. Group sales were up 45.3%, but obviously that number is not reflective of what's going on the ground. That is very much thanks to the recent acquisitive activity. Trust me, if Mr. Price was growing at 45.3% organically, then money would be falling out of the sky in South Africa, and as we can see at Cashbuild, it is not. So the first thing we need to do with the Mr. Price numbers is we need to strip out NKD. That is their recent acquisition in Europe that upset the market so much. If you do that, you find growth of 3.2%. Now, in theory, that's more in line with what we would expect to see. Some might say it's actually quite good because it's ahead of Mr. Price's quoted market growth of 0.8%. In other words, that's what their competitors did as a whole. This implies that they've been winning market share. But how did they win market share? Well, here's the bad news. Comparable store sales were flat. Now, this tells us that the growth all came from new stores in South Africa, and that is a real concern. The store footprint increased by net 32 stores. Trading space was up 3.8% on an annual weighted basis. Now, that's fine, but you really want to be expanding into a market that is supporting what you're doing. If your comparable store sales are flat, then are you really doing well, or are you just throwing money at the problem to grow? Another indication that all is not well is that online sales were up 4.7%, while total store sales were up just 3.1%. Now, Mr. Price puts quite little emphasis really on online sales. They focus far more on being a bricks and mortar cash sales business. But those sales seem to be hard to get right now, with cash sales up just 3.1% versus credit sales up 3.8%. South African consumers are struggling. And here's another flashing red alarm for the local consumer. In the homeware side of the business, growth was just 0.7%. Comparable sales down 3.3%, volumes up just 0.2%, and then obviously new stores making up the difference. Yuppie Chef, star of the show as usual, double-digit sales growth and improved gross margin. Apparel, that's the anchor of the group with a 78.8% contribution. That's clothing, obviously, and shoes, etc., etc. That grew by 3.4%. Comparable store sales up 0.6%, so at least they were positive there, but really not by much. And then telecoms, that's the smallest contributor to group at 3.9%. That grew by double digits. That was up 11.2%. So that is becoming a more important area over time, but it remains small overall. Positives, well, the group protected gross margin over this period, so that's certainly positive. Margin was up 40 basis points during a time in which competitors were highly promotional. Tough scenes in South African clothing. Then we look at Europe, where NKD has apparently outperformed their relevant market benchmarks. That would be the total apparel market and the value segment in Germany as well. But 21 stores were closed, 23 were opened, so only 2 net new stores on a footprint that is now 2,156 stores. So that is somewhat modest growth there, and we'll have to wait and see what numbers come out of there. If there's any other good news, it's that both NKD and the South African business are described as having clean inventory positions. In other words, Mr. Price is basically saying that there aren't big risks to gross margin in the form of potential inventory write-downs, and that is something that shareholders will be happy to hear. I should note that I am one of those shareholders. I bought before the NKD deal, before they decided to go and do this big story in Europe. So this one has also been a tough position for me. I figured I may as well deal with both Cashbuild and Mr. Price in one go, in one video, neither of which have worked out very well for me at all. But I think the bigger point here is that when value-focused fashion houses are struggling like this, while you have the top layer of South Africans buying Yuppie Chef like ice creams on a hot day, you really have to ask some tough questions about our interest rates. I, for one, am very glad that the SARB did not hike rates this week, because I really don't see how South African consumers could withstand it. Then in the last major story of this episode, we go off to Germany, where we find Sirius Real Estate. They are really consistent when it comes to their acquisition strategy. They stick to assets in the UK and Germany, and when it comes to the latter, they generally look for assets with a defense industry flavor. That's because the German government is investing heavily in defense. This is a new world we find ourselves in, obviously politically, in terms of Trump policies and just the isolation of the US from much of the rest of the world. It's forcing Europe to spend more on defense. This is a theme that has been playing out for a while now, and Sirius has found a clever way to participate in this theme at the top of the value chain, or certainly further up the value chain. How do they do this? They go and acquire light industrial assets, properties that is, in Germany. And what this really means is that the tenant is somehow involved in the defense industry. Now, that's not to say that tanks are literally rolling off the line. Often this is really high-tech stuff. So, for example, their latest acquisition, which is a light industrial business park in the northeast of Frankfurt, for 49.8 million euros, by the way, the anchor tenant there is a manufacturer of ballistic protection equipment. So that's quite interesting. It shows you that you could probably put a lot of different tenants in this building. It's not super specialized, but you have a situation where these defense tenants want to be in a similar area. They want proximity to supply chains and to customers, perhaps. Think about how financial services firms tend to huddle together in certain areas like Sandton or Claremont or Rosebank for that matter. You've got a similar situation going on here. Now, this purchase price represents a net initial yield of 7.8%, so that gives you an idea of the pricing here. Weighted average lease expiry, 5.1 years. So not an immediate opportunity, it seems, for Sirius to work some magic on the yield, as they are famous for. Sirius doesn't always buy a fixer-upper. Sometimes they buy a property that they are happy with from a long-term perspective, and that is very much how their defense theme in Germany works. Now, moving on to the Nibbles, the first time that I'm covering them in an audio version of Ghost Bites, but perhaps this is where the future is going, so let's get used to it. Start with director dealings. Unsurprisingly, a number of data tech directors used the script distribution alternative as a way to get their hands on more shares. To what value, I hear you ask? 103 million rand. This is a great time to remind you that the CEO still has a huge stake in the company that he founded, and obviously the bulk of that money is sitting with his entities. Elsewhere, Lewis Group, the CFO there, has sold shares worth over 3.1 million rand. They talk about it being to rebalance his portfolio, but a sale is a sale no matter how you try to dress it up. A director of Santova sold shares worth around 400,000 rand. A director of Tremeton bought shares worth almost 83,000 rand. And a non-executive director of Finbond bought shares worth around 32,000 rand. So that deals with director dealings over the past couple of days. Other stuff that you could consider looking at or diarising, NEPI Rockcastle has announced a Capital Markets Day on the 21st of October 2026, so that's a couple of months away. Well worth it, I think. They'll have deep insights into both the portfolio and the Central and Eastern European region, so you can be sure that property investors will be focused on that. Then ASP Isotopes, of course, they own the assets that used to be inside Renogen. They've got a planned transaction with Noble Africa, and they were part of an investor day where they basically talked through the strategy, and there was a big Q&A. That transcript is now available on the ASP Isotopes website, so if you're interested, I suggest you go take a look. If I get some time before next week, I'll also go and have a detailed look and report back with anything interesting. Then we've got Mustek. Unfortunately, they've announced that Rectron, a wholly owned subsidiary of the group, has suffered a cybersecurity attack. I'm afraid that one feels quite personal today. They became aware of it on the 15th of July, and they immediately followed their process around incident response and business continuity. Now, obviously, in that case, it is really serious because this could potentially mean customer data, inventory. I mean, you can imagine the sort of data that's sitting in a business of that scale. At this stage, they've not given any indication of the scope and extent of this incident, so hopefully they'll be able to contain it and it wasn't too bad, but these things are always quite scary. At Vukile Property Fund, they announced that Global Credit Ratings, GCR, affirmed the credit ratings with a stable outlook. It's very important for any REIT because obtaining well-priced debt is a key factor in achieving solid shareholder returns. Then we go to Sappi. I'm not super surprised to see that Sappi shareholders voted strongly in favor of the proposed joint venture between Sappi and UPM in Europe. Only 1.42% of votes were cast against this transaction. I really don't know why. It's not like Sappi has many other great options available right now. And this is a share price that has lost 55% of its value this year. Not pretty. Quick one on Shuka Minerals. They've announced that they raised gross proceeds of £750,000 through a subscription for new shares at 4 pence per share. That's a 53.9% premium to the closing price on the 21st of July. The subscriber is Menel Energy and Resources, a company that has various mining projects in Zambia. First tranche, which is half the amount, has already been received. Second tranche expected to be received during August. They're also giving warrants to that company to subscribe for up to 18.75 million new shares at 8 pence per share. They can exercise that until July 2029. Remember, the longer the time period related to an option, the more valuable it becomes. And separately, the company also announced that it will issue 375,000 new ordinary shares at 4 pence per share in lieu of accrued fees owed to a former director. And finally, Insimbi Industrial, a small cap that you might not have paid too much attention to. Well, they've added some strong investment banking skills to the board. They've appointed Dean Cromlin as an independent non-executive director. I always find it quite interesting when small caps make appointments like these. And it's also particularly fun for me because I've gotten to an age now where people who I've worked with before or sometimes went to university with or whatever the case may be are starting to get appointed to boards and to leading executive positions. So that's a nice way to end off something positive, at least on an otherwise tough day. And as I said at the beginning, please, if you filled out a capture form, if you did anything on your computer that is unusual when you were on Ghostmail at any stage, please, please, please contact an IT professional, get your computer looked at, and please update your antivirus software that should have picked this up. That's it from me. Hopefully back to normality soon, and I'll certainly make an effort to cover the stories that I've unfortunately not had time for. It is quite difficult on audio. It obviously is a lot longer than if it's written. I'll finish there. Please like, comment, and subscribe to the channel. The rate things are going with how people are accessing websites and cybersecurity. I'm starting to think that this may well be the future for this business, is a newsletter plus these sort of channels. So be an early adopter, get in, subscribe to the channel, and I look forward to bringing you the next one.